What is up guys, welcome back to the channel. We are on the path to find the best financial companies and we are currently looking into the credit services industry. This week we already had Visa, MasterCard and American Express. There is a link for that comparison in the description below. But today we are going down the list and taking 3 smaller companies from the S&P 500. These will be Capital One Financial, ticker symbol COF, Discover Financial Services, DFS, and Synchrony Financial, ticker SYF. In order to make the comparison possible, we will be looking into 8 different factors: analysts' price targets, forward price to earnings ratio, annual revenue growth, price to sales ratio, return on equity, last 4 quarterly earnings results, cash per share ratio, and the dividend yield. The best company under each factor will get a point, so it is possible to have from 0 to 8 points, and in the end the company with the most points will be considered the winner of this comparison. I hope that the rules are clear, an early thumbs up would be much appreciated, and let's begin. The first factor are the analysts' price targets. As investors, we want to check how far the current share price is away from the average target of analysts. If the current price is under the average target, we will consider the stock as undervalued, and in the end, a company with share price is furthest away from the average analyst target to the lower side gets a point for this factor. For Capital One, we have 20 price targets of analysts. They range from the lows of $145 to the highs of $210 per share. The average is at $165.62, and the current share price is at $166.23. This means that the current price needs to go lower for around 0.4% in order to reach the average target of analysts. For Discover Financial, we have 17 price targets of analysts. They range from the lows of $101 to the highs of $142 per share. The average is at $118.76, and the current share price is at $122.04. This means that the current price needs to go lower for around 2.7% in order to reach the average target of analysts. For Synchrony, we have 17 price targets of analysts. They range from the lows of $40 to the highs of $59 per share. The average is at $51.18. And the current share price is at $49.26. This means that there is still around 3.9% room for the current price to reach the average target of analysts. Results for the analysts' price targets factor are in the table, and with most room for growth, Synchrony gets the first point. Second factor is the forward price to earnings ratio. It is calculated by taking the current share price and dividing it by the estimated future earnings per share. This is the standard price to earnings calculation, with the difference that earnings here are predicted by analysts. So in the end, the stock with the lowest forward price to earnings ratio gets a point for this factor. Capital One has a forward price to earnings at 10.33. Forward price to earnings for Discover is at 10.39. And Synchrony has a forward price to earnings at 9.14. Forward price to earnings ratios are in the table, and with the lowest value, Synchrony gets another point. Third factor is the annual revenue growth. As investors, we want to find that the revenues of a company are on a steady increase. We will take a look into the numbers of the 4 most recent years and compare them one by one. If revenue was on the increase from one year to the next, we will consider it as a +1, and if it was on the decrease, it will be a +0. Then we sum the results up to a minimum of 0 and a maximum of 3, and in the end, the stock with the highest sum here gets a point for this factor. Annual revenues for Capital One Financial, and going into 2018, there was an increase to $22.2 billion US. Then into 2019 we had an increase to $22.3 billion, and going into 2020 there was a decrease to $18.2 billion. So with 2 increases and 1 decrease in annual revenues, we get a sum of 2. Annual revenues for Discover, and going into 2018 there was an increase to $7.6 billion US. Then into 2019 we had another increase to $8.2 billion, and going into 2020 there was a decrease to $5.9 billion. So with 2 increases and 1 decrease in annual revenues, we again get a sum of 2. Revenues for Synchrony, and going into 2018 there was an increase to $7.7 billion US. Then into 2019 we had an increase to $9.13 billion, and going into 2020 there was a decrease to $5.8 billion. So with 2 increases and 1 decrease in annual revenues, we again get a sum of 2. Results for the annual revenue growth factor are in the table, and with equal sums of 2, no company is assigned a point for this factor. Fourth factor is the price to sales ratio. It is calculated by taking the company's market cap and dividing it by the trailing 12 months worth of sales. The formula suggests to be looking for a company with a low market cap and a high result in sales. So in the end, the stock with the lowest price to sales ratio gets a point for this factor. Capital One Financial Corporation has a price to sales at 3.08. Price to sales for Discover is at 4.63, and Synchrony Financial has a price to sales at 4.27. Price to sales ratios are in the table, and with the lowest value, Capital One gets the first point. Fifth factor is return on equity. It is calculated by taking the net income and dividing it by the shareholders' equity. A higher ROE shows that the company is well managed and that money from investors are efficiently handled. So in the end, the company with the highest return on equity percentage gets a point for this factor. Capital One has return on equity at 12.51%. Return on equity for Discover is at 25.62%, and Synchrony has return on equity at 16.72%. Return on equity percentages are in the table, and with the highest value, Discover gets the first point. Sixth factor is the last 4 quarterly earnings results. When a company reports earnings, they are compared to expectations of analysts. So earnings can either beat expectations, meet them, or miss them. We will consider that beating expectations is a +1, meeting +0.5, and missing 0. Then we sum the results up to a minimum of 0 and a maximum of 4, and in the end the stock with the highest sum gets a point for this factor. We have quarterly earnings for Capital One, and Q2 of 2020 missed expectations, Q3 beat, Q4 beat expectations, and Q1 of 2021 beat. So with 3 beats and 1 miss in quarterly earnings, we have a sum of 3. Quarterly earnings for Discover, and Q2 of 2020 missed expectations, Q3 beat, Q4 beat expectations, and Q1 of 2021 beat. So with 3 beats and 1 miss in earnings, we again get a sum of 3. Earnings for Synchrony Financial, and Q2 of 2020 missed expectations, Q3 missed, Q4 beat expectations, and Q1 of 2021 beat. So with 2 beats and 2 misses in quarterly earnings, we get a sum of 2. Results for the last 4 quarterly earnings factor are in the table, and with sums of 3, both Capital One and Discover each gets a point. Seventh factor is the cash per share ratio. It is calculated by taking the total amount of cash and dividing it by the number of shares outstanding. Cash per share shows the company's ability to reinvest back and expand, or otherwise to buy back shares or pay dividends. So in the end, the stock with the highest cash per share ratio gets a point for this factor. Capital One has a cash per share at 116.33. Cash per share for Discover is at 66.74, and Synchrony has a cash per share at 28.58. Cash per share ratios are in the table, and with the highest value, Capital One gets another point. The last factor we have is the dividend yield. It is calculated by taking the annual dividend per share and dividing it by the share price. A high yield may suggest that the company's profits are being shared with shareholders, and that is a great passive income source that we as investors are looking for. So in the end, the company with the highest dividend yield percentage gets a point for this factor. Capital One Financial Corporation is paying an annual dividend of $1.60 per share, which is a yield of 0.96%. The annual dividend for Discover Financial Services is at $1.76 per share, which is a yield of 1.46%. And Synchrony Financial has the annual dividend at 88 cents per share, which is a yield of 1.8%. Dividend yields are in the table, and with the highest percentage, Synchrony gets 1 more point. We can calculate the results, so Capital One has 3 points, Discover 2, and Synchrony 3. This means that there's currently a tie between Capital One and Synchrony. So let's remove Discover from the equation and reassign the points. So for the Analyst's price targets factor, the point goes to Synchrony, forward price to earnings point to Synchrony again, annual revenue growth point is not assigned, price to sales ratio point goes to Capital One, return on equity point goes to Synchrony, last 4 quarterly earnings factor point to Capital One, cash per share point to Capital One again, and for the dividend yield a point to Synchrony. We can sum the results, so Capital One has 3 points and Synchrony 4. This means that with 4 points, Synchrony Financial is considered the winner of this comparison. And that was it. If you got value or new ideas, then make sure to push the thumbs up. it helps the channel a lot. Now there is a question for you: do you consider buying any of the tickers mentioned today? Share your stance in a comment below. If you are interested to know exactly when I buy or sell in a stock, then consider the options on Patreon. This week we already did a comparison on large credit services companies with Visa, MasterCard and American Express. And we have 40 weeks worth of investing with the Revolut stock portfolio. If you are interested in any of these, then click on the video currently on the screen. And that was it from my side. Thank you for watching, and I will be seeing y'all in the next one.